Live in five, four, three, two, and one. Hello, everybody. I want to welcome you to another episode of the Capital Gains Tax Solutions podcast, where we believe most high net worth individuals and those who help them, they struggle with clarifying their capital gains tax deferral options. Not having a clear plan is the enemy, and using a proven tax deferral strategy to eliminate the need for the 1031 exchange to defer capital gains tax on businesses, real estate, primary homes, save a failed 1031. Using what's called the Deferred Sales Trust is an amazing way for you to build wealth, to defer capital gains tax. We're also streaming on expert CRE secrets as well, where we bring on some of the best commercial real estate experts to talk about all things real estate. And that's why I'm excited about our next guest. He is an expert when it comes to commercial real estate investing. And in fact, he's out of mostly Hawaii the last 17 years, but now he's in San Diego. Probably one of the best cities in the world, I still think. And he has transacted over $59 million in real estate transactions in 7 states, including Hawaii, Arizona, Texas, North Carolina, Vegas, Ohio, and Michigan. He's also known as an Amazon #1 best-selling author, real estate trainer, and top speaker on leadership, real estate investing, entrepreneurship, marketing, and finance. And he's been investing in multifamily since the mid-1990s. Please welcome to the show with me, Victor Bell. Victor, how are you doing, sir?
Hey, I'm doing great. Thanks so much for having me on today. I really appreciate it.
Absolutely. And for our listeners getting to know you for the first time, would you give us a little bit more about your story and your current focus?
Awesome. My story, I'll give you the cliff notes. So, I got started in real estate investing back in the 90s. Didn't know at all what I was doing. I had got out of the military, dropped out of college, got in trouble, and was on probation and had to get a job. And, I realized 2 things at that job. Most people who had been there for a long time hated their jobs, and I also didn't like it. So I ended up eventually getting a book from the store. And that first year, I did $1.2 million in real estate deals. Found an investment partner. As a matter of fact, my partner then, Bob and Jamie, she's my investor relations manager with our fund. But that actually put me on the trajectory that we're on now. And we've done a lot of deals, I had a lot of experiences with all the different types of assets that we've been into. And now we have our fund, which is a 506C, it's accredited only fund for multifamily focus here in San Diego County.
Fantastic. And Victor, let's dive right into this show topic at hand, which is how to win in real estate today. So I'm curious, Victor, what's the #1 secret that you believe to winning in real estate today?
Well, there's a couple, but the #1 secret is for people to invest with someone else. I honestly, and I'm grateful to be on the show because I get to kind of have a higher level conversation with probably your audience that they'll get it. The way that people were investing a little while ago, a few years back, as rates adjusted and things like that, until now, I believe that unless some investors aren't investing with a syndicator or a fund manager over time, over the next maybe decade, they will not be able to get the quality level of deals that they were going to be able to get before, had they been doing it on a smaller scale or with a smaller group of people. I really, truly believe that. So I think the way to win in real estate now, the way to win in real estate today is going to be through investing with other syndicators and fund managers who are out hunting down these deals, building the relationships that the individual investor who just has some money to play with that says, hey, I'm going to get into real estate. I don't think they're going to have access to that quality level of deals anymore.
Got it. So let me make sure I got that. So it's basically, maybe it's the commoditizing of the business itself. And if you're not working with a professional commercial real estate operator, it's going to be very difficult to get access to the deals. Is that a fair summary, Victor?
Yeah, quality deals. There'll be deals out there, but they won't be. There'll be things that if you have to cut your teeth on those type of deals, you'll start to think that this multifamily residential office properties, you'll be like, I got these little small deals, but they're not panning out the way that I thought. I think that's going to happen to a lot of people.
That's fair. Exactly. What's the secret #2 to how to win in real estate today?
I think going after bigger deals, which leads back into being able to invest with a group of people. I think going after those bigger opportunities, which would take more people to be involved, that's really where the capital is going to be. Because as rates have changed, naturally, let's say 5 years ago, well, a lot of people bought a lot of multifamily property. We'll just use multifamily because that's what I like right now. They bought those properties, they renovated those properties, they refinanced, took capital out, and because from a capital gains 1031 exchange. They took a lot of that money out tax free. So they've already recapitalized themselves and their investors. Now they have good quality assets, right? So if those properties come to market again, they're going to be at a premium, right? So that still warrants somebody to say, okay, I either have to invest with someone else, or I have to go get a really low level quality asset that no one's traded, or I got to go get something nicer, and that costs more money. So I think, again, going after a better quality of deals is going to be more important. That's going to be how you're going to have to win, but you're going to have to pay more, or you're going to have to do that with other people. I think that's the big takeaway for me. And I see it all the time. And I'm sure you do too, as you guys are out there looking, as well as deal with people who want to invest or, kind of get into some of these other things for the capital gains purposes. They're like, where are all these deals coming from? There's not a lot of value add deals anymore. So that portion of the strategy is dried up. They're going to have to go for higher quality stuff. They're going to have to partner with other people and go after different quality and levels, to me.
Yeah, it makes sense, Victor. It makes sense. I think that makes a whole lot of sense. Yeah, larger deals. The analogy I think about is the Amazon effect, right? And what's happening into retail, business in general, AI, automation, technology, the rapid expansion of information, and it's creating and also just the cost of doing business, right? I mean,
Yes.
we're talking about Taxifornia a minute ago before we got on the show, and what they're doing now in LA, Los Angeles alone, where they're charging an extra 5% transfer tax.
Mm-hmm.
You're going to have to scale. You're going to have to scale in a large way, which means bigger deals, more professional operators, and those who have the deep relationships and the deep experience. Otherwise, the risk reward ratio, it's just going to be too high. Doesn't mean you can't get started. Doesn't mean you can't make it big. No, we're not saying that. We're just saying the future of real estate does tend to lean towards, and my thought would be you always want to be an investor. If you can be a broker, be a broker,
Right.
be in the development, basically learn the aspects of the business through like a mentor or by investing, right?
Mm-hmm.
Most people who are GPs are LPs too, right? So it's
Right.
both because they're constantly learning. So I'm with you, Victor. So we got number one is making sure that you're working with a professional, full-time commercial real estate syndicator operator with deep experience and track record. Number two, go after larger deals by partnering with the consolidation of the industry. Victor, what would you say the number three secret is to winning in real estate today?
And it kind of dovetails into the first one. Like you want to have somebody, I say it a little bit plain. I'm like, you need to work with someone who has a little bit of, some battle scars, right? Because I know I've heard people say, well, we've done deals and we've never lost money. And I'm like, well, when's that going to happen? And whose money are you going to lose? Like, like this is real estate with a long horizon, especially commercial. These are not like a single family house flips. Those are great for people who do those, or you buy a house, you keep it and you resell it in 6 or 7 months. When you're talking about, bigger assets, it's like these are 3, 5, 7, 10-year holds, and you need to have somebody who knows like, hey, what is the exit here? Like, have you already dealt with this in the past? What have you done in the past as it relates to being able to navigate these troubled waters? Or are you going to be like, hey, we have to sell, we had no contingency plan? Like, so the third way to win to me is to make sure that whoever it is that you're going to invest with, whether you're investing your money or you're partnering with somebody, is what you were saying, either partner with someone who knows what they're doing, get a mentor, somebody with some future knowledge, but make sure that they kind of have a little bit of scars. You need to talk to people who know this business. That's going to be so much more valuable than somebody who's squeaky clean, because this market that I believe that we're in right now, I think we're full steam ahead into it, is going to be either, it's going to make a lot of people, and it's also going to wipe a lot of people away over the next 10 years. I'm sure if you've been in this business for any length of time, there's people who started a few years ago that are no longer around.
Yep. And by the way, we're talking with Victor Bell. You can find him by going to bell-capital.com. That's bell-capital.com. He's in the Oceanside, San Diego area as well. You might look him up there. Just moved from Hawaii, and he's looking forward to maybe doing some deals with you, finding deals. That being said, let's talk about your unique strategy, Victor.
Sure.
Here it says institutional quality real estate investments for everyday investors, right?
Yep.
But in particular, I want to talk about we go directly to retail investors, no middlemen, no brokers. So talk about your off-market direct-to-owner strategy and how you're able to accomplish that.
Well, that is not about my off-market direct-to-owner strategy. That is actually about not using like placement agents and things like that to go and raise capital, because we tend to deal with retail investors, right? So that's about there. Do we look for off-market deals? The size of deals that we're looking for, it's very, I'm sure anybody who's done larger deals that are in that 30, $50 million range, they're not off market the same way somebody says, hey, we've got an off market deal. We know an owner. Like we call groups that own properties, but when those come to market, they will trade with a broker. So you need to have those broker relationships. So those broker relationships just won't bring them to LoopNet and a bunch of other stuff. They're going to pick up the phone and they're going to call a handful of groups that they think can perform, or relationships that they build, and they're going to give them a shot and say, hey, we have a deal, take a look at it, call for offers are within this time frame, and then we'll move into highest and final rounds. So that's the way that looks. But to your point about the site, that's just saying, hey, we talk to people. We want to talk to a retail investor. We're not going to family offices right now. I don't have the relationships there, to be honest with you. And be honest with you, I've not ever been in those worlds. So I like to laugh and clown, and I'm a little bit loud and stuff like that. I'm a little rough around the edges as it relates to real estate. So I don't have those relationships. I'm making them, but it's a little difficult for my personality at this point. So I tend to just like the business owner. So that's what that means there. So I like retail investors. I do.
Love it. Love it. Victor Bell, bell-capital.com, bell-capital.com. So let's talk about the market itself, Victor. Like, what is your sense now? Interest rates, obviously, over the last 6 months has been just a roller coaster, but mostly not on the good side, meaning interest rates going higher. And although it does seem like things, at least commercial real estate wise, I had a client who's buying like an $8.5 million property up in Oregon, and they locked in at five and a quarter, and I was like, 5.25 doesn't seem so bad, I mean, in comparison, it's not 3.5 as it was, but what are your thoughts just on and I'm talking about multifamily investments right now. Maybe you can talk about what kind of assets you're investing in and kind of what's your temperature for where we're at right now.
It's multifamily, just like you said. But as it relates to what I see out there market wise, I think it's above naturally, right? This isn't a normal market. But the normal market wasn't actually the 2.75, 2.78, or I guess the 3. I would say a normal market rate from my experience in 10 years back, also 3.75, 4.25. That's a normal thing. So to me, this is an inflated area. And I believe maybe over the next 24 months or so, rates will come back down to that 4.25, 4.5, maybe somewhere in there. But what that does is, to me, this is what we're looking at, and I don't mind sharing our strategy, is like we know that some group that has a portfolio of assets in the markets that we look at, those deals are going to shake out. You have billions of dollars worth of loan maturities that are going to be coming up in 2023 and 2024. Someone's going to look at a spreadsheet and say, hey, you know what? Get rid of these because their loans are maturing past where they were. It'll push past what's called a rate cap for people. It's kind of like insurance. They say, hey, we're getting it at 4, and we're going to buy a rate cap that locks us in to whereas if we're on an adjustable rate, which a lot of these loans are, it won't go anywhere past 5 or 5.25. It's already past 5.25. So that's already happening, and they have to pay more money to lock in another rate cap, or it's going to adjust on them and they're going to have to act accordingly, and they have to sell. There's an urgency along that goes with that type of sale. And they've promised their investors, hey, we're going to give you X amount of return in X amount of time. They've already pushed past an extension period, let's say 5 years, and now they're moving into year 6 or 7. They're going to have to they're either going to refinance, which they're not because that rate's ridiculous, or they're going to have to come to market at a discount. I didn't understand that. Again, prior to starting my own fund and getting into this world, I was just kind of buying and selling deals with a handful of investors that are my friends and family and business owner partners. So, but now that I know that, that's what's really on the horizon. That's what people don't see. Now, this may not affect the little guy buying deals. This is going to affect somebody who can, who has money, they're raising capital, they have a fund, and they're going in after bigger deals that would have been normally, some bigger group, some either an institutional type asset or an institutional type group. It's not going to be Blackstone and Goldman and KKR, around in San Diego, but it will be some apartment group that has a heavy portfolio that their investors are more institutional investors. If they're like, hey, we got to get this capital back. So we have to sell some assets to do that.
Got it. Yeah. So the opportunity basically is with the resetting of debt and or the adjustable rate, burning out, and now it's fixed burning out and moving to adjustable, and or the rate caps have burnt out as well. And cost of capital is just higher, and so it's going to be harder to refinance. LTVs or debt coverage ratios aren't going to be as favorable because banks can't get the capital low enough, right? And so people can have to either infuse cash or sell at a discount potentially, which is kind of the interesting part. I'm wondering what discounts will be there, what that looks like. There's so much, it seems like there's a lot of capital even before the shift in the marketplace that was been waiting for decent opportunities, especially in California. I mean, we have with the deals that we had bought in the past, we had been patient and just waited years and years and years. And now we're going to see what happens. But then there's rent control, and there's other challenging things that a lot of people are moving out of California, right? So what's your sense of just California as a whole with multifamily? You've recently moved in from Hawaii, which is a high tax state as well. But what's your sense of the marketplace in California, and what do you think the next couple of years is going to look like?
Well, and that's a great question. So I like San Diego. I don't look in LA County. I think their laws are a lot different than San Diego. There's a lot more lax going on as it relates to what that is. I'm not oblivious to the fact that those things could trickle down. They have not yet. So I like San Diego. I think, like you mentioned Hawaii, I think the San Diego market is actually 10 years behind the Hawaii market. So I've already saw what that market did. I wish I would have bought way more multifamily properties there. They just don't have them. They don't have the assets, the size. So that's my thoughts about this market and about everything going on. So I love the California market, because when people describe California, what they're describing is what they saw in the news about LA. They're not describing San Diego. San Diego has water, mountains, and all of this. So the barrier to entries are perfect. So the valuations for the properties are going to stay. I think rents are going to continue to rise, even with a portion of some of these rent control things, because good people want to pay their rents. So it isn't that happens. And be honest with you, it goes right back to buying a better quality of asset. That affects certain ages of properties, right? But then also, if you don't look for properties that haven't been operated by irresponsible owners, then you don't have to deal with that a lot. Yeah, if you buy a property that's been unattended and the rents are $600 and the current market rents are $2,000, you're not gonna do that, right? But a $200, $150, $600 rent bump, over 5-7 years is not unrealistic in this market or any market per se.
Yeah, absolutely. And I couldn't agree more. By the way, I went to school in San Diego, so San Diego's like still the one of a kind. I feel like the best city in America, right? For all the things that you're talking about. We love San Diego. So that'll be interesting to see what takes place and where things go with the changing of a lot of things that's happening in this world. That being said, we're going to transition to the biggest frustration when it comes to the 1031 exchange. Are you ready for that, Victor?
Sure, let's do it.
All right. So I'm curious, Victor, your experience, right? Being that you're a real multifamily investor, many years, right? What would you say your biggest frustration when it comes to the 1031 exchange?
The timeline after, because again, if you're transit, like the last few deals that we did, that I got the opportunity to 1031 exchange, I just paid the taxes and moved on. Some people like, oh, that's crazy. But I knew, because I was investing in a market that had very limited product, which means I had very limited time based on the constraints of the 1031. I was like, I don't want that noose around my neck. Now other people will handle that differently, but because I'm a real estate investor full time, like I didn't see it as if it was going to force me to now be able to acquire less assets because I had less capital. I just saw like, wow, I'm going to buy a bad deal because I have to do this because I'm fixated on the amount of money that I'm going to lose, rather than pay the taxes and look at the amount of money that I gained by picking the right asset. So that was my take. Everyone doesn't have that take. But that was my biggest frustration, was a timeline and looking for product. Now other people may be in a different circumstance. What was your thoughts?
Yeah, I mean, I think you're spot on with that, Victor. I mean, we call it the shotgun wedding, right? We've all got friends and family who've got married, quickly under the gun, maybe, or some uncertain circumstances, and they look back and they, ooh, shoot, maybe I should have slowed that down a little bit. And or we call it letting the tax tail wag the investment dog, right? Where you're
Hmm.
just buying it because you've got this big, heavy tax of 25 to 50% of your gain being taxed,
Right.
right? And so you end up maybe making decisions that you shouldn't have, taking on more debt. That's the other thing about it too, is you need to buy equal or greater value, which also means equal or greater debt. You need to replace the debt. And so what you find is people just keep trading up. And if they get caught in the wrong time where they need liquidity, or these rate caps are adjusting, or they overpaid and didn't
Yeah.
underwrite the property as disciplined as they should have, then guess what? The whole thing can come crashing down. And that's what happened in the '08 to '11 market, especially in Sacramento, where I was at. And we saw friends, family, clients lose half or everything because of the 1031 exchange. Is also why we're passionate about eliminating the need for it by
Mm,
providing what's called a deferred sales trust, not to be confused with the Delaware 1031, which is another form of a 1031,
mm,
where we can not only save a failed 1031, but we can eliminate the 1031. It also works for primary homes and businesses,
mm.
cryptocurrency, which once the funds are tax deferred, this is the cool part, Victor. I'm curious what you think about this. The funds can be invested back into passive real estate deals with someone like a Victor, right? So you can go from like stock market or crypto or big primary home on La Jolla Beach that people own for 30 years. You can sell defer the tax not using a 1031, and then you can invest it and diversify it across multiple asset classes with no timing restriction. And so my brain exploded when I learned about this, because we thought we were
Mm.
the Navy SEALs of investment real estate and brokerage. I grew up in the Bay Area with my family doing 1031s and building houses. And then we learned about it at Marcus and Millichap, going, wow, well, this will change everything. But I'm curious, Victor, had you heard about this before?
No, man, I'm all ears. I don't know if you noticed, but I started leaning into my computer like, oh, really? Because I had people ask me about this all the time, and they're like, "Hey, could we 1031 exchange into your fund?" And I'm like, "No, we don't. We're not set up that way." But when you were talking, I was like, "Oh,
And we looks like we lost Victor. He's going to jump back in. Here he comes. He's back.
I'm back."
You're back, Victor. Yeah, you were just saying you ask people to 1031 into your fund sometimes, but you have to turn them away.
Yeah, yeah, I do. And when you were talking, I got excited. I was like, "Oh, wow, this may be a way to do that," because I don't like telling people no when we have a vehicle that would actually help them.
Exactly. And I think that's at the end of the day, that's we love to solve people's problems and help them get to their desires, right? Whether that be passive cash flow freedom, whether it be retirement freedom, whether that be selling that big house and getting some diversification. A lot of people feel real estate rich, sometimes cash flow poor,
Mm,
or exiting out of that business or that cryptocurrency at the high. We love to help people not only sell, unlock some of that freedom with the capital, but then also unlock those freedom with their time and their energy. So if you want to learn more about that, about how to build a capital gains tax exit plan, you can go to capitalgainstaxsolutions.com. That's capitalgainstaxsolutions.com. You can also check out the new book that just came out with Kevin Harrington from Shark Tank and a few others, called Building a Capital Gains Tax Exit Plan. That's on Amazon. Actually, right now you can pick up a copy. Go to capitalgainstaxsolutions.com or search on Amazon, Building a Capital Gains Tax Exit Plan. That being said, Victor, are you ready for the lightning round?
I am. Let's go.
All right. Knowing what you know now, if you could go back to your 25-year-old self, what's the one golden nugget you make sure to tell yourself to do?
Someone just told me that too. I would actually be focused more on raising capital than just running around and finding deals. I would reverse polarity. Before I tried to find the deal, go find the money. Now I would have made those connections with more business owners, more people who had capital, more investors, and I would have built my relationships with them, because my ability to find the deals, it's now reverse in my world, right?
Perfect. That
So
makes
that would be
perfect
the
sense.
change. Mhm.
Excellent. Question number two. If there's one thing you could do in your business this year that would make the biggest difference or have the biggest domino effect for the rest of your business, what would that be?
I would hire more people. I would get employee heavy, and we would focus all of my departments would actually expand. So mine would actually be implementing more people and more employees in my companies.
That being said, what would you feel the number one hire is for you right now? If you had that hire, who would that be and what would that look like?
Probably somebody more willing than skilled. I tend to look for a lot of people who are skilled in a lot of areas, and I find that they have the capacity, but they have the capabilities, not the capacity. So willingness to want to grow, expand, and work in a company that's not going away. That's the best hire for me.
Fantastic. What's the number one book you've recommended or given the most in the past year?
A lot of people ask me about that. I don't have a book. One of the things that I did listen to was called How to Invest. It's by the guy from the Carlyle Group. I thought that was really good because it gave me a brief overview of some of the big players like Larry Fink and Gray and all these other guys from Blackstone, and some of the other people. So that was a good book to listen to for people interested in how people on the upper level actually think and what they did.
How to Invest. And who is that by again?
Ooh, he has a
look up Blackstone, look up How to Invest. They'll pop up or something.
No. This was the guy from. Hold on, it's right here. So I'm on Audible.
He'll find it.
I apologize, guys. I
Otherwise,
apologize.
You want to look for more, you want to look at Victor, go to bell-capital.com. That's bell-capital.com. We'll just keep moving. That's fine.
Yeah,
This is
yeah,
a
yeah.
lightning round.
Yeah, it's How to Invest. But it's the guy from Carlyle Group. The guy,
Carlyle Group. Look it up. It'll be there.
Yeah.
Google, Chat GTP. He'll know it. They'll figure it out for you. Next question. What are you most curious about right now?
Honestly, most curious about my next big wins. Like, I don't know what that's going to look like. I know once we get to 1,000 units, I want to push forward to 4,000 units. Once we're at that phase, I don't know what that's going to look like. So I'm curious about that, how my world's going to expand at that point and all the people that are with me.
Fantastic. Last question, Victor. After all your success, helping all the people you've helped, building the wealth you've built, I'm curious how you best stay centered in your values and then stay encouraged to charge forward to reach new heights.
My family, my wife, my kids. I have grandkids already. They mean the world to me. So that reminds me, then I also have my personal goals about who I believe I'm going to be in the world. And I stay very fixated on sticking with that. So those are my personal values. And then it spills out to my family and the people that we're working with.
Victor, it's been more than a pleasure getting to know you a little bit here on the podcast. I want to thank you for sharing your wisdom with us, getting in the trenches with us, geeking out a little bit about tax, and talking about real estate, what's going on, especially in San Diego and Hawaii and all of those things. So thank you so much. For our listeners who want to get in touch with you, would you remind them one last time what's the best place for them to find you?
For sure. They can go to bell-capital.com. You can find me there, or you can Google Victor Bell or bell-capital or Bell Capital, and I'll pop up everywhere. I really appreciate you for having me on today. I really do. I enjoyed it.
Absolutely. I want to thank our listeners also. We appreciate all of you out there that are listening, that are watching on YouTube, that are doing that little thumbs up, a little subscribe, that sharing, and just being a part of the Capital Gains Tax Solutions or Expert CR Secrets, family out there, if you will. We appreciate everybody. We want to encourage you to take action. Get with someone like Victor. Contact Victor. If you're in San Diego, especially, or in California, you're looking at deals and you're looking at ways to build wealth. You want to be running with those who have been there, who have a track record, and who are closing and finding deals. Because you want to build wealth as if you want to be wealth. And I'm assuming if you're listening to the show, you want to build wealth. So I encourage you to do that. And if we can help you at all, we'd love the opportunity to serve you. You can go to capitalgainstaxers.com for anything that has to do with exiting highly appreciated assets, deferring the capital gains tax. It doesn't need to be $1 million net proceeds, $1 million gain. That's our minimum. But you can download our free ebook, or you can get the new book, Building a Capital Gains Tax Exit Plan, right now on Amazon. It is live. It is hot. It is there. We're excited about that. That is all for today. And we look forward to connecting or talking with everyone again soon. Thanks so much now. Bye.